Let's go, folks. Good morning, one and all. See, they're hyped up. You hear this crowd, you think it's for opening bell. It's actually to kick off our show. Welcome to the Street's opening bell broadcast here for Post 35 on the floor of the New York Stock Exchange. Today is Monday, the 7th of November. Happy Election Eve. I'm your host for the next hour, JD Durkin. Opening bell rung here. Look at my collar. What's going on here? You got to make sure it's like fixed. That's live TV. I think we're doing it great. Opening bell rung moments ago here by Wisdom Tree. You just heard them there over my shoulder. This to celebrate the company's first day of trading on the NYSE. Congratulations to them. Welcome, my friends, to the ultimate wait and see week here on the street, as in there will be new consumer inflation data out. We will all wait and see what Thursday brings. There's also another week of earnings, so we wait and see what names like Rivian, Disney, and AMC all have in store. And oh yeah, you may have heard tomorrow is the midterm elections. We all eagerly wait and see who will control what and where. By the way, to find everything you need to know to cast your vote for tomorrow, including the location of your polling place, please go to vote.org. It is free, it is safe, secure, and nonpartisan. Remember, bad politicians are elected by good people who don't vote. Let's take a closer look for what's on tap for this morning's broadcast. Apple making headlines over the weekend. Might have big implications on the stock. I thought it was interesting, we'll break this down with Martin, that they chose to reveal this information on a Sunday, not in the heart of the news cycle week, but we'll get into that in just a bit. Midterms, of course, also top of mind as election day looms. Does it ever? And finally, we will talk the Musk Twitter drama. What? There's drama between Elon Musk and Twitter? You're kidding me. Of course there is. We'll also talk all of that as the chief twit continues to shake up the company. See, that's what he called himself. That's not like a mean nickname that we're giving him. For more on those stories and so much more on this Monday morning, let's now bring in the one and only, our senior editor and markets correspondent for TheStreet.com, Mr. Martin Baccardax. Martin, good morning. Happy Monday. Been a minute since you and I have gotten to do this together. With so much going on this week, we always look at the major market indexes and we wonder what's baked in. What's baked in and what's not? What outcomes, I wonder, especially over the next week, Martin, do you think are currently being baked in by investors and what's not?
I think that's a great way to kick off the week, actually, JD, because I think for the most part, what investors have baked into their assumptions about performance is largely related to earnings. You have the sense now that about 430 S&P 500 companies have reported. The numbers have been solid, but not great. Earnings are going to expand by about 3.5% when compared to the same period last year. You strip away energy, however, the most volatile component of the earnings segments, and you are actually going to get a decline of around 3% from last year's levels. So the numbers aren't great. Heading into the fourth quarter, we're probably going to see another round of declines, at least compared to 21 levels as well. So I think with respect to what is baked in, earnings is probably the answer. What is not, of course, is where the Fed is ultimately headed in its rate hike cycle. We got some indication of that last week, but it was a mixed set of messaging. We had the statement following the Federal Reserve 75 basis point rate hike, which seemed to indicate some dovish leanings of Fed governors. However, Chairman Powell, when he spoke to the media 30 minutes later, was adamant that it was too premature to talk about a pause and that the Fed had a long way to go to reach its terminal rate. Again, that mixed messaging only confused markets even more and sets us up for a number of weeks of sort of indecision as we digest the data and try to read the tea leaves with respect to the Fed's next moves.
Because you and I haven't spoken since we heard from Jay Powell last week. I wonder, Martin, do you find yourself looking more closely at what Jay Powell says in his more improvised, off-the-cuff responses to reporters? Or are you inclined to put a little bit more stock into what's carefully written, phrased, and released ahead of time? Because obviously in the moment, he's going to be inclined to answer questions. He doesn't know what the questions are or necessarily who they're going to come from. So if there is a little bit of a pivot between the two, is there one over the other, I wonder, that you tend to put a little more weight into?
I think I'd probably put more weight into the statement because it's more a reflection of the collective views of the Open Markets Committee as opposed to those of just one man. Now, I will give Chairman Powell the benefit of the doubt. I think that he is well-intentioned in the way that he speaks to the media, and he wants to make sure that markets don't get ahead of themselves. Perhaps he's cognizant of the mistakes that he and the Fed made last year with respect to their sort of description of inflation as being transitory. So he isn't terribly excited to see markets ramp up quickly as a result of any change in Fed language. So he immediately went out there and tried to tamp down expectations of a pivot or a dovish tilt or whatever it might be. But on balance, JD, I would say I would take the views of the committee over the views of Powell writ large, but clearly he is an important steward of those views, and as such, what he says has to be respected and has to be given the proper weight. But at the end of the day, I'd still say it's probably the committee over the chairman.
Martin, you may be familiar, there are elections here in the United States tomorrow. I wonder how the results of those elections could impact the broader market. I guess this kind of gets back into the first question about what's being baked in. Do you have a sense here that maybe, just maybe, investors are saying, all right, well, we probably assume Republicans will take the House. Maybe they take the Senate. Governor's mansions might be a bit more of a jump ball, but are we sort of heading towards a potential where investors are prepared for what the polling suggests and what history suggests, which is that incumbents don't do very well during midterms?
No, they do tend to be. It's such a difficult platform to run upon, particularly when you're looking at the fastest inflation in 40 years and rising gas prices and all the rest of it. Even if those can't be materially put down to the administration in power, people tend to see it as a way in which to maybe voice their disappointment with some of the broader decision making. And I'm sure that's at play in these midterm elections. It's interesting for me, JD, as a non-American, to watch these simply from an observant point of view without necessarily any sort of skin in the game, because I can see the way that the arguments are taken on either side. And they're compelling, it has to be said. I think Republicans have a point with respect to some of the missteps from an economic view from the Democrats. Democrats equally have a point when they say that a large portion of the economic malaise is a result of things that are happening outside of their control. So there's a sound debate to be had. But I think in larger terms, what investors are very likely positioning themselves for is Republicans taking both the Senate and the House, and that will mean they'll have control of the upper chamber for a fourth consecutive Congress, and they will be able to neutralize some of the executive orders that Biden might have been relying on in the second half of his term. To put it simply, that kind of gridlock is exactly what markets want, because they would prefer that companies operate in a bit of a political vacuum as opposed to one that is potentially sensitive to decision making either at the executive or at the legislative level. Now, historically, as you say, we've had rallies that follow midterm elections for each of those elections since the Second World War. In fact, in 17 of 19 of those elections, the market has outperformed on a 6-month basis. In all of them, it's outperformed on a 12-month basis. So irrespective of who's elected tomorrow, there's a very good chance that stocks are going to rise. But the headwinds that markets are facing right now with respect to decelerating earnings, accelerating inflation, and a hawkish Fed are probably more powerful than anything we're going to see from a Republican-controlled Congress, a split Congress, or whatever result we get tomorrow.
So here's what I want to know from your perspective. You know that I've been out of the country for a week and a half. I just came back yesterday. I was watching late night NFL football. Of course, just bludgeoned over the head every commercial break. Attack ad after attack ad after attack ad is the thing I most despise about election season. Are elections like that overseas, with all the nonstop advertisements that just flood and just flood the airwaves and totally just lull you into the sense of never-ending frustration? Because I can't wait for the election to be over, Martin, so I can stop watching those commercials.
No, it's very much an American phenomenon, unfortunately, JD, it has to be said. The biggest difference that I always see between election campaigns in the United Kingdom and Europe and here in the United States is this. Prior to voting, the day before voting in any European country, the media essentially shuts up shop. There's no more exit polling. There's no more predictive polling. There's no more reporting about activities related to voting. And basically that silence is held until an agreed point after the vote, at which all networks will then begin to sort of roll out their projections for victory. And I think that's a really important component in media coverage. I personally find it quite distasteful that U.S. media companies find themselves with this responsibility to call elections. I think it's anti-democratic, and I think it's voter suppressing as well, when you consider that people are calling results at about 11 o'clock Eastern time when people in California have yet to go to the polls. But oddly, I would say, JD, alongside that, the biggest difference is the attack ads do tend to be a bigger component of American political discourse than they do in other countries, for better or for worse.
I find myself being very depressed after that answer you just gave, but I definitely learned a lot, and that is the point of the show. We want people to be a little bit smarter, and I appreciate that context because I truly did not know what it's like overseas, and it puts in sharp contrast the things I most dislike about our system here at home. Great night, by the way. A great call about election night calls from the media desks, by the way. I really appreciate that context. I do want to jump to, if we can, off the election for a bit. I want to get your perspective here on Apple making big news, and first I want to get your take about anything you have about why this was released on a Sunday. But regardless, I do want to pull up the statement that the company did release on Sunday, and it has to do with COVID-19 restrictions in China. The company says restrictions there have temporarily impacted the primary iPhone 14 Pro and iPhone 14 Pro Max assembly facility located in Zhengzhou, China. Facility is currently operating at significantly reduced capacity. We now expect, says the company, lower iPhone 14 Pro and Pro Max shipments than we previously anticipated. Customers will experience longer wait times to receive their new products. Martin, not exactly the type of statement I'd imagine that Apple wants to be putting out weeks before Thanksgiving, right?
No, I think you're absolutely right. I think the timing of it, JD, was probably predicated on the fact that Foxconn, which operates that plant, issued a statement itself on Sunday saying it was probably going to have to revise its December revenue forecasts as a result of these restrictions. And I've been writing about these restrictions for the past couple of weeks and how they've affected activity at that plant, which is a really important one. There's 200,000 people working there. It's the biggest iPhone factory in the world, and there were video elements that many of us saw last week of employees fleeing the premises for fear of being locked in as a result of this closed-loop system that Chinese companies will often operate within when COVID restrictions force the gates to be locked, essentially. So once Foxconn had made the statement about the revised revenue forecast, it seemed to me that Apple was left with no choice but to say there was probably going to be some shipping implications in there. Now, they had hinted towards that in their September quarter earnings update and the conference call that they had afterwards in late October. So it wasn't a terrible surprise, but I think now people are starting to put some flesh on the bone with respect to those delays, and that's why you're seeing the decline in Apple stock today.
This point about delays, it now takes 31 days, Martin, to receive a new iPhone 14 Pro if that device is ordered through the Apple website. That according to a note we got from a JP Morgan analyst yesterday. How much of an impact do you expect this to have on the company's bottom line, especially before the holiday season? Again, this is the time of year when Apple wants nothing but good headlines, but because of the challenges there at its Foxconn plant, which you said employs about 200,000 people, they have to sing a little bit of a different tune in early November.
Yes, I think that's absolutely true. We're seeing some indication that the revenue forecasts for iPhone sales are going to be implicated for sure. But really, I think analysts are kind of putting a wait-and-see approach in place until they understand more about exactly how long the restrictions might last. The last round of COVID restrictions are set to expire on the 9th of November, so that's in a couple of days from now. If there's some sort of process by which the factory can tool up quickly, then those delays may not matter. Now, I've always been surprised, JD, at the ability for Apple customers to desire the new products, even if they only have very incremental benefits in terms of switching over. And by that, I mean from iPhone 12 to 13 to 14, the changes have been relatively minute. They've mostly been focused on the camera, certain portions of the operating system, but hasn't really been a game changer with respect to iPhone development for a number of years now. But people still seem to like them. So demand, I think, will ultimately overshadow these shipping delay concerns into the holiday quarter. And if there's one company that you'll bet on in terms of being able to execute through it, it's most definitely Apple and CEO Tim Cook.
When you see all these headlines with regards to China's COVID zero policy, how is any company, Martin, supposed to navigate through that policy in this moment, knowing that, like you said, there's an imminent deadline here scheduled a couple days from now where perhaps some regulations would be loosened, but aren't we ever just a couple of weeks away, another spike of the virus or perceived spike of the virus throughout regions of China that will be significant headwinds for any company that does business in that country? How are companies supposed to figure this out?
No, I think it's such a great question, JD, because not only is it an issue for companies that rely on China for the supply chain, but it's also going to have implications for any attempt that the Fed has to tamp down inflation, because we understand now much better than we did before how significant supply chain disruptions, or how significant a role those disruptions play in the acceleration of inflation. So if we are continuing to see COVID restrictions hammer supply chain developments over the next few months, it's going to be much more difficult to slow inflation going into the first part of next year. Now, underscoring that, JD, is the fact that it's also having severe implications for the Chinese economy itself. There was trade data out last night that showed the first simultaneous decline in exports and imports for the Chinese economy since the COVID pandemic of 2020. And that was a big surprise to a lot of investors. Now, oddly, Chinese stocks rose as a result of that data, in my estimation, because people are looking for further policy support from Beijing to offset the impact of these COVID restrictions. But from what we're hearing from senior politicians, from the health department, and virtually everyone else at the highest levels of Chinese public life, there's no change on the forefront with respect to these restrictions going forward. The country's going to hold on to that COVID zero policy because they want to be absolutely sure that they can eradicate it into next year, despite the fact that nearly every health official in every other part of the world says it's the wrong tact. China is not one to change its mind quickly. And once they take a decision, they do tend to hold it to the bitter end.
Yeah, I mean, right now, at least as of just 17 minutes into the trade here in the session, Apple's currently down 1.3%. A tough week last week as well. Continue to follow to see how that headline or other similar headlines continue to weigh on that particular stock. I do want to play sound here from an interview I had last week, Martin, and get your perspective on it on the other side. Last week at Web Summit, I sat down with Henry Ward. Henry's the CEO of Carta. He told me he thinks that a bit of a recession might actually be a good thing. Healthy was the word that he used for the economy. He also told me he thinks that he's more in favor of having the Fed continue to raise rates as it needs to. But I also asked him specifically if he thinks we are already in a recession. Here's how he responded.
If we aren't today, it's coming. You know, when I talk to CEOs, I was talking to a trucking CEO the other day, and he was saying like trucking demand has dropped 50% over the last from a year ago, and that's a great proxy for demand. It's a great proxy for inventory. It's a great proxy for supply chain. But all that stuff that demand has gone down, but it hasn't trickled yet into earnings.
So, Martin, he says there that trucking demand...
If we aren't today, it's coming. You know, when you...
I think I'm hearing it again. He says that trucking demand could be a sign of things to come. I wonder how big of a canary in the waning demand coal mine something like trucking markets actually can be.
I think he's right to look at the disruption. I'm not sure that comparing it to this time last year is exactly the way to go, simply because when we had those severe supply chain disruptions and products started to break through and come in to the United States, there was enormous demand for trucks, of course, to move it around because of the pent-up demand. So I think it's the difficulty in predicting exactly how, if or when we are going to enter recession is based upon the fact that we have to navigate through these sort of vagaries in economic data and comparisons that have been rather bumpy since the COVID pandemic. We've had ups, we've had downs, we've had pent-up demand, we've had receding demand, and all of it has made the predictive abilities of different data points, from trucking demand to rail demand to inflation, not exactly the best precursors of where we're headed from an economic point of view. The U.S. Treasury yield curve is probably the best indicator we have at this point as to whether or not the economy is going to tip into recession next year. It's been flashing that warning sign for more than a year. But what we do see now, JD, is a little bit of a paring back in bet on big Fed rate hikes. And if that were to continue, then there is a chance that the U.S. could avoid that recession, or at least have one that's reasonably shallow. And I say that in large part because job markets remain bizarrely resilient to the weakness that we're seeing in other parts of the economy. So that, along with some consumer strength, just might, keep the U.S. from tipping into recession, or at least one that's prolonged or pronounced in a serious way.
And our full interview with Henry Ward, the CEO of Carta, is up now at TheStreet.com. I do encourage any of our viewers to head on to the site and check it out if you're interested to hear what Henry had to say as we sat down at Web Summit. Martin, moving on here, we'll certainly get much more into this later this week. I suspect this will be a top topic of conversation, especially come Thursday. But I'm hoping on this Monday for now, we can at least set the stage a bit and talk about expectations for Thursday's consumer price index figures. What will you most be closely following? Of course, keeping in mind, we're like in at least 100 news cycles between now and Thursday. We're gonna have a whole new reality by the time we get there. But I'm curious a few days out, what you think will be top of mind for you.
Unfortunately, I think this inflation release isn't going to offer the clarity that markets are looking for, and that is a bit of a shame because it's the last CPI headline into the December rate hike. But what we are likely to see is a moderation in the annual headline rate. That's probably going to come down to somewhere in the 8% range, down from 8.2 in September. That's certainly not a big enough decline to change anybody's forecast with respect to where we are headed, but at least it's welcome news. What we're likely to see, however, JD, from a month-on-month basis, is a bit of an uptick in inflation pressures, largely as a result of the change in gas prices. There was a rally in oil markets into the middle to end of last month that are probably going to bump gas prices a little bit higher. The expiration of pandemic gas relief tax breaks are also going to lift prices not only at the end of October, but into November as well. So we may see that replicated in November data that we will receive in the latter part of December. So all that to say, it's going to take a few months to sift through, again, the noisy aspects of inflation data that are capturing the headline numbers. The trend is uncertainly abating. In other words, we are seeing a slowdown in inflation, and arithmetically it's going to slow quickly into next year as well, simply because of the comparison periods. But will it slow fast enough for the Fed to feel comfortable that we're getting back to the 2% target in a reasonable amount of time? And if so, will they change their perception of the terminal Fed funds rate, which markets right now are pegging at around 5 to 5.25%? And that's 0.25% higher than they anticipated only a few weeks ago. So your point is exactly correct. Everything can change in a 4 or 5 day period, and it's very likely to do so in a 4 or 5 week period afterwards.
Yeah, of course. Well, at least sets the stage in terms of expectations, potential expectations, and I like to kick off Monday morning's broadcast to give our viewers a better sense on what the sort of headlines are that they'll be facing for the days ahead. I do want to turn our attention here to earnings if we can, because it's still earnings season, folks. We got some big names this week, too, and I wonder if we could start chat with a little bit of Lyft, because we were expected to hear those numbers after the close today. Uber had a revenue beat, also had strong guidance last week, but Uber and Lyft are not necessarily comparable companies. Uber has things at its disposal like Postmates, Drizzly. Uber Eats is a business that Lyft does not. So it's not exactly an apples to apples comparison, even if people are inclined to say, well, Lyft and Uber, like if you have one, maybe the other does perform similarly. What will you be most closely following for Lyft as they report after the bell, Martin?
I think we'll probably get a similarly optimistic view of the December quarter from Lyft, simply because we are seeing evidence of the consumer demand in terms of movement. And by that, I mean travel and trips and various things like that. The airlines have told us so. Airbnb has told us so. And we also got similar forecasts, as you referenced, from Uber as well. Lyft has had a tighter control of their purse strings, I think, as well, comparative to Uber. As you say, their business model doesn't give them the offsets of things like food delivery and drinks delivery and other aspects like that. But I think the fact that they probably saw their sort of overstaffed situation a little bit more, with a bit more prescience than some of its rivals, will give it a little bit of a leg up heading into the final months of the year. But it doesn't have the scale that Uber has either. So therefore, even minute alterations in its forecast could have big implications for the stock. It's not one that I'm hugely comfortable with going into the final months of the year, but I think we'll see some incremental positives from the numbers and the forecast for the December quarter as well.
Yeah, absolutely. Like we said earlier in the show, we also will hear from names like Rivian from Disney later on in the week as well. So on top of everything else, folks, don't worry. We're going to have no shortage of earnings news to bring you as well. Is your head spinning yet? It's okay. It's only Monday. It will by the end of the week. Speaking of head spinning, let's talk Elon Musk and Twitter, because I'm actually the whole time I was away, Martin, I would really sit there from time to time as I would see news updates or read new tweets from Elon Musk, and my brain would inadvertently say, wonder what Martin thinks about this. So now is my time to find out. We've seen a flurry of tweets in recent days about new ideas, in lots of headlines about cost-cutting measures, i.e. job losses at the company. Some prominent figures, Martin. These are people who built the company over many, many years. I mean, do you sit there and wonder is Elon Musk making this up as he goes? What is your take on how he's trying to manage the early days of this company? Through the perception of doing this in a very public way, right? He's sort of tweeting out new ideas and sort of farming ideas from the public as he goes. What stands out to you after a bizarro couple weeks?
The parallel for me, JD, that makes me smile is I harken back to about 15 or 20 years ago when I was living in Britain, and the BBC was going through a management change. The top position there is called the Director General. And for the first time, the BBC brought in a Director General from a private broadcaster, from somebody out in the public space. So that broadcaster himself, who had been running a rival network called ITV, described BBC as swimming in a jacuzzi of cash, because every citizen in the United Kingdom that owns a television has to pay a license fee, and that money goes towards BBC programming. Now, once he took over as BBC Director General, within weeks, he was talking about the need for more money and to raise the license fee because he didn't have enough to make the programming that he liked. It took literally about 2 weeks for him to change about 20 years of criticism of the way that the BBC operated. So in some respects, what I'm seeing from Musk is very similar. His criticisms of the company as an external observer are now being tested by actual economic reality, and that is why he is changing his tack so quickly. I think it's pretty obvious that he fired too many people too quickly. He's asking some of them to come back right now in order to make the economic reality a little bit firmer. The fact that he used to say he didn't care whether this was a money-making company has now turned completely on its head. He's trying to get advertisers to come back in. He's trying to put down some new rules on content moderation that will ensure more advertisers don't flee and that more celebrities, which many people come to the platform to listen to, don't follow suit. So I'm not terribly surprised that he's made such significant 180s over the past 48 hours. Maybe I'm just surprised that it's so quick. Normally, these guys take a couple of weeks before they realize that the difficulties they're going to face are far more significant when they're at the controls versus when they're standing on the sidelines. For Musk, maybe because his mind moves more quickly, it took about 2 days.
Well, you know, what's interesting, Martin, is that we did have this apology from Jack Dorsey for hiring too many people too quickly. So I wonder is it that Elon Musk is firing too many people too quickly? Did Dorsey hire too many too quickly? Or is the truth kind of somewhere in the middle?
Probably somewhere in the middle. I found Dorsey's comments really unhelpful in this situation and really, quite frankly, disrespectful to the people who lost their jobs on Friday. I might have a personal angle to this because unemployment is just a situation that you don't wish on anyone, particularly when an economy is set for a downturn. But for somebody who's, sort of waiting in as many billions of cash as Jack Dorsey is, to talk about the fact that he may be hired to.
Okay, I think we just lost Martin there. His feed, he was in the middle. We were talking about Jack Dorsey, of course. If you missed that headline a couple days ago, Jack Dorsey, of course, the founder, longtime leader of Twitter, essentially making an apology in light of all these cost-cutting measures from Elon Musk. Dorsey apologizing to say, perhaps we grew the company too much, i.e. perhaps we brought on too many people, too many engineers, too many content moderators or producers onto the platform that now have forced Elon Musk's hand to now fire. I do believe we do have Martin back, if I'm not mistaken. Martin, if we lost you as you were talking a bit about there, Mr. Dorsey, I'm hoping you're willing to revisit your previous comment so we could try and bring that thought to a close. You got me, Martin? No, we don't have Martin. Okay, no problem. No problem. We're going to work to get up Martin here. I'm also going to get Martin's take as soon as he's back about where he's optimistic and where he has concerns. Because I think if you're a regular Twitter user, there might be things that you've seen announced that might make you kind of optimistic about the direction of the platform, i.e. things for content monetization. If you're a content creator, longer video feeds you've never had on Twitter. Maybe that's something you kind of like. Obviously, maybe you have other concerns as well. Let me confirm with my producers. We have Martin. We've lost Martin. We do not have Martin. All right, folks. Well, I'll tell you what. It's just about 10 o'clock. That's more or less our cut time. We will have Martin back at some point, of course, tomorrow morning. We're going to touch on that as well as our rapid fire sections. So that is going to do it, folks. Welcome. Yeah, thanks for tuning in this morning. These things happen in live TV, folks. That's going to do it for Market Open here from the floor of the New York Stock Exchange. We will be back with Martin tomorrow morning to talk about all those topics and much more. Don't forget to vote. Stick with TheStreet.com for more on these and all of the major market stories. that matter to you. We'll see you tomorrow.